When you deposit your paycheck, you might picture it sitting safely inside a heavy steel vault, waiting for you to withdraw it. In reality, the moment your money crosses the teller's counter, it leaves the physical world and enters a high-speed digital network. Banks treat customer deposits as raw material, immediately putting that capital to work to generate institutional profit. Profit is extracted through three primary mechanisms: the core engine of interest rate spreads, the stabilizer of service fees, and the accelerator of the capital markets. Maintaining the illusion that a bank is a storage facility obscures the mechanics of how that same capital is being used to build wealth for the institution, rather than the account holder. To see the core engine in motion, we can trace a single $100 retail deposit. This chart illustrates the fractional reserve system. As shown in the top row, Bank A holds 20% in reserve. The other $80 is lent to a new borrower. The bank pays a negligible interest rate to the depositor while charging the borrower a higher rate, pocketing this difference, the spread. The math continues as that $80 is deposited into a second bank. Bank B holds a 20% reserve and lends $64, which is deposited into Bank C and relent again. This graph charts the result of that multiplying effect. Following the orange line, an initial $100 deposit expands until there is $500 circulating in the system. The banking system has manufactured $400 of new digital money, backed entirely by new debt. This manufacturing process turns the local branch into a factory for credit and debt, extracting continuous interest from every layer of the economy. Lending carries inherent risks, particularly when an inverted yield curve forces banks to pay more for short-term deposits than they earn on long-term loans. To protect themselves, banks pivot to Pillar 2, fee-based income. This includes account maintenance and overdraft charges and mutual fund management fees. These fees are generally immune to central bank interest rate fluctuations and broader market volatility. This structure acts as a financial shock absorber, maintaining high institutional profitability even when a recession slows the pace of lending. Moving beyond simple retail accounts inevitably leads us to the massive institutional world of investment banking and capital markets. Here, the bank acts as a capital matchmaker, underwriting new stocks and bonds to help corporations raise massive amounts of funding. Revenue in this sector is driven by high-value M&A advisory services and in-house trading, generating massive returns that fluctuate with the economic cycle. While consumer deposits provide the baseline raw material, these capital market operations act as the accelerator that supercharges institutional wealth during economic booms. When you zoom out, you see that nearly every dollar in the modern financial system, beyond physical coins and notes, exists only because someone, somewhere, owes a debt to a bank. This creates a cycle where new loans are constantly created to fund the interest required by previous loans. A $1 million loan at 5% requires $1,050,000 for repayment, necessitating a larger volume of debt. The impact of this system depends on how an individual interacts with it. Many consumers borrow to fund depreciating consumption, while wealthy individuals use tax-advantaged loans to acquire assets growing faster than the interest they owe. Individual deposits fuel a global credit empire. Navigating this ledger determines whether an individual's wealth is consumed by interest or compounded by it.